is capitalize on it the best you can and get out of Dodge.
Gold stocks really sort of underperformed bullion over the last little while, or last few years.
Couple of years.
Why was that?
I think it's the worries about a bear market and the fact that gold stocks are stocks and tend to perform with stocks and not bullion. They are riskier because they have business risk. The ETF, the gold ETF, has made gold very accessible, so the need to own, so the gold mining stocks don't have a monopoly on people who are concerned about monetary debasement. I think that's been a big factor.
Right. The spread between cash cost and the price of gold these days, it's you know, watching how far gold has run has got to be advantageous to the balance sheets of these gold companies.
Yeah, I mean the spread, I think the global cash cost number is something like $800, and take $1,600, that's an $800 spread. That's unprecedented.
And that's, so at some point that would suggest that investments in the larger gold stocks are a pretty good idea.
I think these companies will be gushing cash flow, and they're going to bump their dividends and report record earnings, and I just think they're going to be too profitable to be missed out on by not just people who are interested in gold, but the generalist investor.
Right. Now, here's a question. Your fund has outperformed all the relevant indexes by a fairly wide margin, yet you're not really a trader. So how did you do it? What was is it stock selection? Is it what's the secret sauce here?
The secret sauce?
Yeah.
Well, we have a big investment in research. We have a good team of 4 analysts plus me. We travel all over the world to look at gold mining assets in remote locations, whether it's the Arctic Circle or West Africa. I mean, we've been pretty much everywhere.
Right.
And that kind of gives us a pretty good lay of the land as far as the assets go. And I think the big thing is that we're willing to invest in companies at an earlier stage of their evolution than most, because we do have this kind of nitty-gritty feel for assets at their earlier stages. And so we'll get involved with an Cisco, for example, when it was a 50-cent stock.
Right.
It's now 14, and we finance them all along the way. And I think that makes a big difference.
Which is a good lead into the next question, which is the producers have, you know, it's a business where you deplete your reserves on a daily basis if you're doing things right. How are they going to replace their reserves, and does that point to an opportunity? I mean, do you guys spend a lot of time looking at the companies that are most likely to get acquired?
Well, certainly, most years we'll have a couple of takeovers, and hopefully they're big positions in the portfolio, and that certainly gives us that certainly is a big factor in our performance. But the other thing is, you know, we're very patient. We'll look at a company that may have made a misstep, but if we think the asset's any good, and if we think management is contrite, or maybe new management comes in, the gold isn't going to go anywhere. I mean, it's there. And so if they get things right, you're going to eventually see value created.
So, what to do now? Let's get practical. In the first instance, to take advantage of volatility, you have to have courage and you have to have cash. And cash gives you courage. You have to have liquidity. I was talking to a gentleman last night before dinner who said that he's afraid of holding dollars. I asked him to give me his. I have had periods of time in my life when I had lots of dollars, and I had periods of time in my life when I had no dollars. No mystery. I am happier now that I have lots of them. It is true that the purchasing power of US dollars or other fiat currencies are going to decline. Maybe 5% a year, maybe 6% a year, I don't know what the number is. Losing 5 or 6% a year in purchasing power beats the hell out of losing 30 or 40% in equities markets, okay? It's simple math. You have to have some liquidity, because if you don't have liquidity, you won't be able to take advantage of volatility. And having the cash in your portfolio may give you the courage to act. Maintain liquidity. It's okay with me if you maintain a lot of that liquidity in bullion or bullion-related products, as long as you understand that at least that part of your bullion isn't an investment, but is rather a substitute for other forms of liquidity. If you paid $1,800 an ounce for the gold and there was a more attractive opportunity elsewhere, and the gold was at $1,700, if you viewed it as liquidity and were willing to sell it at $1,700 to do something else with it, in other words, if you didn't have a psychological attachment to the gold, but rather were using the gold as a liquidity, that's a wonderful way to prepare yourself. But absolutely, positively, you must have liquidity. Do you remember 2008? Anybody here remember 2008? Do you remember what happened to people that didn't have liquidity? It was truly and profoundly ugly. And if you have the cash and if you have the courage to take advantage of crisis, the problem becomes other people's problem, not your problem. And while that isn't an optimal solution, it's the best that you can hope for. After liquidity, what are we doing? Well, I'm delighted to say that at Sprott, at least at my part of Sprott, we are increasingly attracted to precious metals equities. Why is that, people say? I mean, the precious metals equities have underperformed this year. That's why we're attracted to them. For the last 3 years, we have felt that precious metals equities have been rather expensive. We think it's no particular surprise that the gold price has outperformed the index of precious metals equities. We think this happened for 5 reasons, and I think this is important. You need to understand these 5 reasons. In the first instance, gold equities underperformed in the last 2 or 3 years because they performed so well 4 or 5 years ago. We think that gold equities anticipated the increase in gold and silver prices that we've seen in the last 2 or 3 years. The second thing that we think happened in the context of the underperformance of gold equities has been the increasing attractiveness of the gold and silver-oriented ETFs. In other words, there's been disintermediation in investment markets between gold and silver equities and gold and silver represented by other forms of paper like the ETFs. The third thing, and this is much more problematic, has been extraordinarily poor corporate performance on the part of the view of the gold miners. You would have expected, at least I expected, that given the fact that their product price increased from $250 an ounce to $1,500 an ounce, a 6-fold increase in product prices, that the free cash flow generated by the industry would have grown by leaps and bounds. But it didn't. In fact, free cash flow in the industry grew anemically. And the ratio of cash in to cash out, that is, exploration and development expenditures relative to free cash flow in the gold mining industry, actually declined for most of last decade. In other words, these guys, despite the fact that the product price increased 6-fold, found a way to spend more money than they took out. In fact, the industry destroyed capital. No wonder the corporate performance was poor. The fourth thing is inflation. Not the kind of inflation you think about. The kind of inflation that you think about is the issuance of phony paper by various governments. Well, let me tell you something. Wall Street and Bay Street and Howe Street, the people who print up gold mining share certificates, these guys do inflation like nobody else. Anything that the public sector can do, the private sector can do better. And these guys issued phony gold mining share certificates even faster than the Federal Reserve issued phony greenbacks. So although the prices of individual equities didn't go up, the market capitalization of the sector expanded dramatically. We went from probably 1,000 juniors worldwide to 4,000 juniors worldwide, and we had floats going from 20 million shares to 100 million shares. So the sector generated its very own private inflation. And the fifth thing, of course, is, at least with regards to the juniors, probably 80% of the issuers are absolutely valueless. They have no value whatsoever. I know you don't want to hear this, but it's important that you hear it to understand it. If you merged every junior gold explorer in the world together. Let's say there's 3,000 of them, 4,000 of them. Let's call it Vancouver Explore Co. It's not limited to Vancouver. They come from Perth and London and everywhere else. These 4,000 companies, if you look at the money that they spend on, I don't know, exploration, stuff like that, fast women, slow horses, all the essentials in exploration, what you'll see is an industry that in a very good year loses $2 billion, and in a bad year loses $6 billion, $7 billion. So how do you value this business? Do you value it at 5 times losses? Or because gold is in favor, do you value it at 10 times losses? I mean, if these were technology businesses, you'd probably value them at 30 times losses. That's the question. So, why with this litany of complaints would I possibly be buying gold and silver exploration stocks? Well, in the first instance, remember that we had price anticipation. That is, that the share price levels anticipated the growth in the bullion price. That's no longer the case. The delta between the increase in the gold price and the increase in the share prices has disappeared. With regards to the ETFs, as a consequence of the first, we think on a valuation basis, the equities offer better upside than the ETFs. With regards to poor corporate performance, finally, after 10 or 12 years of investments, the industry free cash flow is growing by leaps and bounds. We anticipate that the gold mining industry this year will generate as much free cash as they have generated in the last 10 years combined. This is the year where cash in by way of investment is generating cash out by way of operating margin. And this cash is extremely important. It allows these companies to grow organically without issuing new equity to shareholders. It gives them the courage and the ability to acquire junior companies to maintain their production profiles. And these acquisitions add both hope and liquidity to the system. This is extremely important. Script inflation. There are fewer and fewer issuances taking place as a consequence, first of all, of the legitimate companies having good free cash flow, and increasingly a confidence of the fact that people like you are much less likely to buy junk gold stocks than you were 6 or 7 years ago as a consequence of your own education. And this is very, very, very important. So we see for the first time in 3 or 4 years real value being offered in the gold and silver equities markets. We are particularly attracted ourselves to the smaller capitalization discoverers and developers who we think will be taken over by larger companies.